We're going to walk through the big questions.
If you look at where the economic data has been coming in during the second quarter, it's been mostly disappointing.
You can see the black yield curve. You're looking at 30-year yields over 4.5%.
The market is sort of right in the middle of this green circle, but we just added this extra circle in the lighter green.
At the correlation between US stocks and international stocks, which has come back down.
We're going to walk through the big questions. We're saying the agenda is we're tackling the big questions. These questions will be broken up into a few key topics. The first, of course, is we're going to address the questions about a weaker economy in the second half of 2025. We'll talk about inflation. Brian will do both of those. He'll go into bonds. That's when he's going to introduce Kevin to talk about the opportunities within muni markets. Next, we'll be talking about equities, where Jay Peters is going to look at what catalysts are for global equities, talk about positioning and valuations. And then the so what, and this is really important. Anna Gonzalez will talk about what's going on within our overall asset allocations, looking at what's happened within the 60/40 portfolio this year. And then we will transition to what can we do about it? Where can we look for better risk-adjusted returns? That leads us to talk about some volatility strategies with Michelangelo Dooley, as well as the great, big, beautiful world of alternatives with Maxwell Snyder. So with that and a very full agenda ahead of us, I will turn it over to Brian Nick to tackle that first big question.
Thanks very much, Cameron. So, question number one, are we expecting a weaker U.S. economy in the second half of the year? I guess I'll spoil this up front and say possibly, probably even. If you look at where the economic data has been coming in during the second quarter of 2025, it's been mostly disappointing. And that disappointment has actually been accelerating over the last couple of weeks, even the last few days. This graph is through this morning's poor new home sales data. Almost all the economic data that we're seeing coming out of the US is falling short of expectations. That doesn't mean we're in recessionary levels. It just means that the economic data is not coming in as well as we expected and as the consensus expected. And there's two ways for this to resolve. We can either see expectations fall, or we can see the economic data start to turn better. Expectations have already fallen. One reason why you haven't seen a bounce back in economic forecasts, the same way you've seen a bounce back in equity markets, is that the preponderance of the data continues to come in below expectations. This is a very different story than we've seen in the last 2 calendar years. In both 23 and 24, as we pointed out coming into the year, expectations were pretty soft to start those years and were revised up during the calendar months because the data came in better than expected, especially the consumer data. That has not happened in 2025. We came into the year with very high expectations, especially as they were being revised up in the fourth quarter. And those expectations have fallen significantly to the point where we're now expecting, consensus is expecting 1.4% GDP growth for the year for the US. That would mean that we're annualizing at about 1.6% in the first half of the year. That would mean somewhat weaker growth in the second half of the year, though not catastrophic recession level growth. One thing that we've been interested in is watching is the betting markets. These are not useful for every single thing you can look at. Anybody who watching the betting markets during the New York mayor primary last year knows how much they can move around. But for recessions, what we're interested in is the perception that the U.S. is in danger of falling into recession has fallen significantly since April with the announcement of those Liberation Day tariffs. Since then, we've seen them fall as those tariffs were walked back and as very little of the data looks recessionary. But at the same time as we're seeing the average expectation for growth fall, we're seeing the recession odds fall too, which all that means is your average expectation is falling, but the uncertainty band around that is also closing in. So instead of thinking that there's a wide band of uncertainty around where growth could be this year, it looks like consensus is forming around a slower growth rate, but without as much of a left tail risk in the form of recession. And one of the reasons is that because the tariffs are not as severe as first put into place in early April. One thing we are watching though is that the unemployment level is continuing to move up. This is the absolute number of workers classified as unemployed. These are people in the labor force, but not currently working for economic reasons. And that number has been coming up. It's over 7 million now. It's come up for 4 straight months. The unemployment rate has also been rising slowly. That's pretty unusual. You can see on this graph, those black lines, when they're rising, they tend to rise very quickly. Unemployment sort of takes hold in the economy very quickly, and recessions happen sometimes without much warning. But this time around, we're seeing this happen very slowly. So it's a historically very different type of environment. But in the coming months, this is likely to move higher, not lower, even with the contracting growth in the size of the labor force. And you can see consumers also perceive this as well. One thing we really think consumers do a good job of identifying in these consumer confidence surveys is how healthy the labor market is. Do they know somebody who just got a job? Do they know somebody who just lost a job? Do they have a friend who just posted in their window a job opening? And the perception among consumers, and that's this black line here, which is inverted, is that the labor market is getting a bit worse. The ratio of jobs being easy to get versus jobs hard to get is turning a little bit against us. And that is typically happening as the unemployment rate is rising. And this indicates that there could be a further rise ahead in unemployment. The last thing I'll just identify here on the macro side is business sales. When small businesses are identifying poor sales as one of the things that's becoming a problem for them, that tends to also happen at a little bit ahead of when unemployment's going to be rising, because one of the things that small businesses obviously can do in response to poor sales is to lay off workers. In that context, I mentioned tariffs a little bit. One of the reasons why there isn't seen as the sort of the cavalry coming to the rescue here with lower interest rates from the Fed and a lot of stimulus coming in the very near term is that inflation is also a significant fear. So what we could be seeing this year potentially is a repeat in a muted sense of 2022 when we saw growth fears and inflation fears take hold at the same time. Some people call that stagflation. What we aren't seeing, though, in the data through the month of May, so significantly into the year, is evidence of higher inflation. In fact, inflation seems to be on a glide path down to close to the Fed's 2% target. The last 2 months in particular have been very soft, and we're expecting that the PCE data for the month of May that is going to come out this week is also going to be soft. That's the one the Fed really pays attention to. So all signs here at the top level pointing to pretty quiet inflation, but we know the expectation of many economists and of the Fed is that inflation is going to be higher in the summer months because of the impact of tariffs that take a little bit of time to set in. Consumers are onto this. You ask consumers about what inflation is going to be over the next year. They have these very, very high forecasts that are completely unprecedented, except in times when the gasoline price is spiking, which has not happened. You can see that black line has been below zero. We're in a falling gasoline price environment for the most part, but inflation expectations have gone to the moon. And the reason that's happening is consumers are concerned about tariffs and track tariff revenue, daily revenue. This is looking at it averaged over the last 2 months because it's a very jumpy, bumpy series. But you can see that the U.S. is taking in a lot more tariff revenue, which means that things coming into the country are being charged those tariffs. Maybe not completely in totality yet. We probably haven't seen the full force of the tariffs in terms of the daily revenue impact, but we know that that is potentially going to be leaked through into higher prices. Where do we expect we're going to see this? Goods, especially durable goods like cars, where we know there are high tariffs already in place. Anything with steel and aluminum, which are also have very high tariffs attached to them as components, also potentially could be rising in price, but that's going to take a while. Inventories get wound down existing because of things on the shelf get bought and sold, and then only then do you have to import new things and pay those higher tariffs. But this has already started to show through in car auctions. So auctions for used cars are starting to show signs of inflation already ahead of what we think is going to be the major impact from the tariffs. Where are we not going to see as much inflation, or actually see less inflation? In rents. Annualized monthly rent changes have become very soft, very normal. We can actually see this line go even lower. So if we're annualizing a significant part of the inflation index, CPI, PCE, which is shelter, at a lower rate, that's going to make up for a lot of the increase in inflation we're likely to see from goods. So there's a little bit of a seesaw going on. Services inflation is likely to be coming down regardless of what's going on with the tariffs. Goods inflation is likely to be coming back up. And net, we might not see, in fact, we don't think we're going to see nearly as big a spike in inflation as we did in 2022. Last point on this as we transition into the policy question, especially as it concerns rates and bonds. The deterioration in the macroeconomic data has not had as much of an effect on the market's perception of what the Fed's going to be doing, and indeed even the Fed's own forecast of what it plans to do, as it normally would. This black line hasn't really moved down that much. That's telling you where the market thinks the Fed funds rate's going to be at the beginning of next year. Come down a little bit in the last few days on some dovish commentary and some weak data, but not as much as that economic data surprise index, which has been cascading, would have you think. And the reason is that the Fed is still cautious about the inflation outlook. It still has to weigh these two risks against one another. It can't only pay attention to the slowing growth data. So the third question is, can bonds continue to be a hedge against weaker growth now that we have this sort of dual risk scenario in the ether? Cameron pointed out the zoo steepener that we've seen in the U.S. Treasury yield curve. This has been a really powerful story for bond investors, for bond markets. Compared to a year ago, short-term rates are considerably lower. The Fed pulled those rates down. You can see by the shape of the very short end of the curve, the 2-year rate being low, the 3-year rate being low, that rates are expected to fall further. But further out on the curve, despite the fact the Fed cut rates last year, the 20-year rate and the 30-year rate are higher than they were a year ago. There's many reasons for that. One of them being lingering concerns or emerging concerns about the state of the U.S. fiscal situation. You haven't seen, again, similar to the Fed funds rate graph that I showed just a minute ago, for the amount of economic deterioration we're seeing, we're not seeing as much of a hedging property in the 10-year Treasury yield as we might otherwise see. There's something else keeping this yield aloft. One of the things is the perception we think that there's going to be this large fiscal impact, this large impact to the deficit, and potentially a stimulative impact to the economy from the One Big Beautiful Bill, OBBB. What's interesting about this analysis, though, is it leaves out the impact of the tariff. So when you look at the Congressional Budget Office, which tries to analyze each of these things in isolation, the impact on the deficit from the One Big Beautiful Bill, which is estimated to be about 2.8 trillion additional borrowing over the next 10 years, is almost completely offset by, or exactly offset by, the additional revenue that will come in from the tariffs. And this allows for changes in interest rates that will result from these policies, changes in economic growth. So this is all dynamic. It's an estimate, but the fact that these numbers are so close together leads us to think that the market may be overestimating on both sides the degree to which this is going to be a market moving fiscal policy environment that we're in. Is it going to be extra stimulative with lots of new deficits and borrowing? Not if the tariffs stay in place. Is it going to be a complete disaster from a fiscal standpoint and be this huge tax increase on households and businesses from the tariffs? Well, there's also a lot of stimulus happening at the same time. So the fact that these two things offset each other leads us to think that there shouldn't be a huge impact, perceived impact on the debt and the deficit moving forward. The one thing we would say does need some relief in the form of lower interest rates is the housing market, which is, I think everybody on this call knows, has not been functioning normally for at least a few years. The fact that mortgage rates remain so close to their highs for the cycle has led to kind of a semi-permanent decrease in demand. That worked for a while not many people were listing their homes, but now that they are listing their homes, we are starting to see prices come down. The latest numbers we got just for the month of April, we got those yesterday from both the government and the private source of home price movements. Both of those have home prices moving down in the last 3 months. And that's a concern for the consumer outlook. That's a concern for the overall economic outlook, the perception that if your house is not worth as much as you thought a month ago or a quarter ago, you might behave differently as a consumer. So that's something to watch. Still want to approach this from an investment standpoint. Where are the opportunities in bonds? If we don't think there's a big fiscal blow up about to happen, but bonds still seem attractively valued in many respects, we want to know where to look for that source of opportunity in the market. So I'm going to turn it over to my colleague, Kevin McIntyre, who's going to talk about the municipal markets where we do see a lot of opportunities for investors. So Kevin, I'll drive the slides, but you take it away.
Okay, hello everybody. Thank you, Brian. Yeah, I mean, just furthering Brian's discussion on yields and where we see the bond market, what I can say about the municipal market is that we started the year with pretty attractive valuations, but 6 months later, the case for municipals is very compelling. Muni yields are dramatically higher since the end of last year in December, since looking at mid-year 2025. You can see the black yield curve. You're looking at 30-year yields at over 4.5%. A year ago, they were about 370, 375, 376. So the longer end, longer dated bonds have cheapened dramatically. The reasons why: investors flock to the front end of the yield curve. Your bonds inside of 10 years and 7 years and in yields are actually lower than a year ago. So that's the best performing area of the yield curve. Investors have been concerned about the things that many people have been, muni investors, concerned about tariff and macro policy, the economy. They're also concerned about the status of the municipal bond exemption, which put a lot of pressure on the municipal market. And I think that led people away from munis. But with the recent headlines and what's going on with the Senate working the House bill right now, it seems the municipal exemption is going to stay intact. So that fear seems to be behind the market, but issuance continues at a record pace. Last year was a record issuance in the market. This year's showing no signs of letting back. Issuers were rushing to get their bonds out in the market ahead of changes in policy. So those things have led to quite a bit of pressure in the market. And as you can see from the yellow line to the black line, munis are significantly higher. Yields are elevated. We're right now hovering around a 4% after today, the overall yield to worst of the market. Other than the tariff concerns a few months back, you saw where yields did spike up. You're about 40 basis points cheaper than the start of the year of the overall yields of the market. So historically speaking, there's a very compelling case to go to munis, especially when we look at these next two slides. One of the best ways of measuring municipals is looking at their taxable equivalent yields versus other asset classes. And right now you're looking at about a taxable equivalent yield of a 672 for the municipal bond market versus a 507 for corporates and a 410 for treasuries. So if you look at the gap in in recent months, that's quite a wide gap. So on a taxable equivalent basis, munis are a tremendous value right now. And that's not taking into account high tax states like coastal states like California and New York, where you would be seeing that taxable equivalent yield in the 8% category and even higher California. And one thing that has also changed this year with valuations in munis is they look cheaper relative to treasuries, which is a standard way of measuring munis richness and cheapness in the asset class. Right now, you're close to 94% for 30-year municipal bonds. That's 20 and 30 years. So 94% of treasuries, which is on the cheaper side historically, 75 for 10 years, 71 for 5 years, which typically are in that 65 to 67% of treasury range. So even the front end with its outperformance is still cheap. So all throughout the yield curve, municipal bonds are cheap, but especially in the longer end where investors have been hesitant to extend duration up to this point. One other thing I want to talk about is high yield, which had a very good year last year. High yield munis outperformed quite a bit. But if you look at the yield advantage over high yield versus the investment grade, I talked about that 398, call it 4% yield of the investment grade municipal world. You're really only looking about a one and three quarter to 2% higher yield for high yield munis, which even though fundamentals overall have been pretty steady and strong in the municipal asset class, certain sectors have come under pressure, and the high yield space is a little bit of a different subclass within municipals for sure. If you are going to play in this space, there is appreciation opportunities, of course, but from a yield perspective, you're really looking at one and three quarters to 2% if in additional yield with significant more credit risk. So just to wrap things up, the case for munis, regardless really of where rates are headed, the yields are elevated. They look cheap to most all other fixed income, especially on that taxable equivalent basis. Fundamentals remain relatively solid for most sectors and credits. The tax exemption concerns are mostly behind us. Summer months tend to be better performing months for municipals. So the case to add duration or work yourself out of some shorter T-bills that you've been in and done well with, I think the case is certainly there for municipals right now more than ever. And with that, I will pass things off to Jay Peters to talk about equities.
Great. Thanks, Kevin. Hey, everybody. We have a pretty big question. What's the next catalyst for global equities and what segments will lead? We'll attempt to answer some of this and give you our thoughts. And I think just starting at the high level in equities, I have a lot on this page. Certainly a lot to cover from the first half of this year. Interestingly, if you went to sleep on January 1st and you woke up today, you saw the S&P up 4%, you'd say, yeah, it looks like it's been a relatively smooth year, but it has been anything but in equities. We've seen historic levels of uncertainty, volatility, one of the fastest drawdowns earlier in the first half, and then followed by one of the fastest recoveries. And we're kind of knocking on the doors of all-time highs once again. So I think one of the big takeaways from the first half of the year was that the great expectations that we talked about definitely did reset in a number of areas. If you looked at positioning entering the year and sentiment, they were both very crowded and elevated and highly bullish. A lot of those have reset and they're actually below average levels, which is, in our view, a tailwind to equities in the coming quarters. Yeah, I'd say fundamentals have actually improved as well. Earnings for Q1 were much better than expected. That's certainly a healthy sign, especially given that the valuations on the broader S&P 500 are pretty lofty levels. But I think, our view for the back half of this year is consistent with what we said in the first half. It's expect greater volatility. We expect a wide, choppy range in equities. That has certainly played out. We do think that there is this potential for a continued melt up in equities, get into some of the rationale there. But I think in this environment of elevated volatility and choppiness, it remains prudent for investors to be disciplined around valuation, not taking on excessive risks. It's not a great environment for that type of risk taking. We want to prioritize diversification and really benefit from the ability of global equity markets to provide risk management to portfolios, as we've seen international markets do so far this year. And then I think prioritizing fundamentals is going to be critical in an environment with stretched valuations and a tough environment for corporate profitability. The companies that can deliver on earnings expectations are likely to continue to be rewarded, as we've seen. So we show this chart every quarter. It's a look at sort of our scenario analysis of what multiple is currently on the S&P 500. What's the earnings growth projection for 2025? We're currently sitting at about $263 per share, trading at 22 and a half times earnings. So the market is sort of right in the middle of this green circle, but we just added this extra circle in the lighter green to show that there are a wide range of outcomes. The multiple can certainly drift higher here. and we'll get into why. And then we think there's potential for earnings to either come in a little bit better than expected, or if we do see great increased trade uncertainty and more restrictive policy, it's potential that earnings growth does not materialize and meet those expectations. So just important to remember that the market is typically volatile, but this is probably going to be one of our more volatile years, as we've already seen. On the next page, we want to show the valuation of the S&P 500. So as you can see today, we're getting back up to those levels we last saw in 2021. So 22 times forward earnings. It's a market that's probably 15% above its 10-year average valuation. So not wildly expensive. And in some ways, you can argue that valuation today is justified based on profitability metrics in a lot of companies. But I think for these multiples to stay at these levels or even push higher, which is certainly possible, we're going to need to see operating margins and gross margins at the average company continue to hold up and probably reach record levels, which we'll get into on the next page. When we look at why the S&P has carried this higher multiple and why it could go higher, it's a lot of the index heavyweights that account for over 30% of the index. They have great profitability. Most of the Mag 7 names generate a lot of free cash flow. They've thus far produced a lot of impressive returns on invested capital. And so that composition is certainly a driving factor behind the current multiples. But I think if you just look at the chart on the right here and the top 3,000 companies in the US market, today almost 40% of them have gross margins above 60%. If you go back to sort of the mid 2000s, less than 25% of companies had that level of profitability. So we've definitely seen increased profitability across the market. And that's really why we've been able to push higher on the valuation side. But as we said, for those valuations to stay at these levels or expand, we're going to need to continue to see this level of profitability. We wanted to just quickly touch on positioning. We said at the beginning of the year, it had gotten very extended on the bullish side. Back in March and April, kind of at the market lows, the positioning for institutional investors had reached about as negative as it gets. And thus far, it has recovered a little bit. But as Cameron said, institutional investors have really sat out a good portion of this recovery since the April lows. They remain generally underweight equities, and that rebuilding of long positioning is a potential tailwind to equities as those investors come back into the market. We can call it a pain trade or a melt up, but as the market continues to grind higher, more and more of these institutional investors are resetting their positioning and getting back that average level. Just looking at the earnings growth forecast for the coming year, we do have an expectation of record operating margins on the S&P 500. We've never seen 17% operating margins, but we're going to get to $263 of earnings per share. That's likely going to have to come from operating margin expansion. We typically don't get that when we have measures of PPI and CPI that are relatively benign, at PPI at 1.4%. And we also don't see that when we have revenue growth of, say, 4 to 5% for the rest of this year. And we have seen companies so far really surprise on their profitability. Companies have reduced headcount and maintained revenue growth over the past couple quarters. So we will certainly need to see that continue. But I would say this is a lofty expectation and one risk to the overall EPS estimates for the S&P 500. This is an interesting consideration for equities. We have seen earnings estimates declining for probably since last fall for 2025 and 2026. You can see here on the right side of this chart, those expectations have now started to level off and actually tick slightly higher. This is not the best market timing tool, but it does act as a headwind or tailwind to equities. When you see analyst revisions and earnings expectations falling, typically you see the S&P follows suit, and conversely, when expectations are rising, it does tend to support a bull market. So we're closely watching these measures, and if they potentially bottom, that's another reason to be optimistic around the path for equities going forward. Where there has been divergence in the expectations is really between the large growth segment and the large value segment. The large growth segment, a lot of which is made up of the Magnificent Seven stocks, is actually holding up very well. They posted a very strong first quarter of earnings growth. If you look at the value segment, those expectations continue to get cut. And this is one reason why we think market breadth and we might see greater concentration in the market going forward, is because as those earnings expectations continue to gravitate around the growthier names, it just presents a bit of a challenge to the sort of broadening out of market performance. On the next page, we have a look at this sort of main question. What's going to lead going forward? Will it be those secular AI type growers, or will we see a cyclical recovery or a broadening trade? On the left side of the page, you can see we have the earnings expectations for the coming quarters for both the Mag 7 and the other 493. So those expectations are going to start to normalize. The Magnificent 7 has produced phenomenal earnings growth over the past couple of quarters. As they've gotten bigger and they're up against tough comparisons on a year-over-year basis, those growth numbers are going to start to come down. And we do expect to see greater participation and earnings growth from the other 493 names. So you can see by Q1 of next year, both segments are probably on pace to produce about 10% earnings growth. So I think from a fundamental standpoint, that does tell you that there is a case to be made for broadening probably later this year. But on the chart on the right, I think what we looked at here is the equity market performance and the Fed path of the Fed funds rate. So this is looking at 2026 Fed funds futures, and as you can see, the Magnificent Seven in the sort of navy blue or blue line has actually correlated pretty well with the Fed funds futures rate. So when people are expecting a more dovish Fed or lower Fed funds futures, we have seen better breadth in the market, but better participation from the average stock and small cap stocks. But as those Fed funds futures have drifted higher here in the last couple of months, you've seen once again the Magnificent Seven sort of lead the market higher. So this is something to closely watch. I think if you do get healthy earnings growth that comes in as expected from the other 493, and we get a more accommodative Fed or a little bit of a greater chance of cuts in the coming quarters, maybe we do see better breadth. But I think at this point we would say that's a wait and see item, and we want to probably prioritize companies that are less dependent on that Fed funds rate for performance. International markets have been an incredible bright spot this year. The performance has vastly exceeded that of the US markets, both from developed and emerging market economies. What we saw is the dollar has been a factor in this performance, but it's not the entire story. There has been a substantial increase in 2025 and 2026 earnings estimates. I believe policy uncertainty is a little bit less so in foreign markets. The environment for consumers has been a little bit more supportive for consumption. And we're seeing that come in flow into their earnings expectations and the earnings growth. So we still think international markets are attractive valuations relative to the US. They've served as a great diversifier in portfolios. I think that can continue to be the case. I think the path for the US dollar is generally going to continue to be weaker, but I think we'll see bumps along the way. Putting all that together, it just tells you it's a good time to just make sure you're not too far underweight international equities. And on our last page, I just wanted to wrap up with a quick recap of the quality factor and why we continue to prioritize this factor in our equity strategies and just as a firm. Quality is a type of attribute that is really built to withstand volatile periods and periods of uncertainty. You get earnings consistency without a lot of rate sensitivity. Quality as a factor performed very well in the drawdown we saw in early April. And I think given where valuations are in the broader equity markets, I think continuing to prioritize these higher quality companies that are adept at creating shareholder value and consistent earnings growth should continue to reward investors. And I think with that, I'll turn it over to my colleague, Anna.
So the next big question is, when we're thinking about building out portfolios, where can investors look for higher risk-adjusted returns? So I'll start out by highlighting some of the dynamics that we've been observing from a cross asset class perspective. The first one being bonds starting to act like bonds within portfolios. In this graph, you can see how stocks and bonds are not as positively correlated as they've been in the past. Correlation just referring to how the prices of these two asset classes move in relation to one another. And right now, if you see, we're effectively close to zero, still nowhere near 2010 levels where there was this perfect negative correlation, but not what we saw in 2022 when stocks and bonds were both getting crushed. So we go on to the next slide. Another interesting dynamic that's been taking place is the diversification benefit international stocks have had in portfolios year to date. Here in this chart, we once again look at the correlation between US stocks and international stocks, which has come back down. So for many investors this year, being globally diversified has finally paid off, which is one of the biggest reasons of when we look at a 60-40 portfolio, the performance year to date looks pretty solid. What we're showing here in this slide is that despite the massive drop that we had in April, if you held 60% in stocks and 40% in bonds, from the beginning of the year till now, you'd be up 6 to 6.5%, which is actually not that bad. If we take a step back, though, and just look at where we stand today with valuations creeping up, the dollar being in this oversold territory, which may potentially not act as much of a tailwind to international stocks, credit spreads continuing to be in this tight territory again, growth projected to slow down. All these things make us wonder, how easy will it be to repeat this for the rest of the year? So we go into the next slide. If we take a look at where we are headed into the second half of the year, we continue to view the market environment to be somewhat muddy. With that in mind, we're maintaining a neutral stance across both equities and fixed income, and we continue to believe that broad diversification will continue to play an important role into the second half of the year. Mike Goldstein from Empirical also pointed out we aren't really getting paid to take on a lot of big bets or really do anything right now, which naturally raises a question of, okay, what can we be doing across portfolios to add value? And in our view, the most compelling opportunity continues to lie within alternatives, where we remain overweight and where we continue to see the greatest opportunities to really generate that additional alpha within portfolios, particularly through strategies that offer uncorrelated return streams or can capitalize on market dislocations. So, if we go into the next slide, I'm going to just quickly recap some of the comments that Kevin and Brian and Jay walked through. Just starting off with fixed income, like I mentioned, we remain neutral, continue to prefer municipal bonds, just given where yields are at on an after tax basis. Credit spreads look pretty tight still, meaning we don't think investors are really getting compensated to take on extra risk there, which is why we maintained our up in quality bias, leaned into high quality securitized credit with a preference for investment grade over high yield. If we turn over to equities on the next slide, you can see here that we're neutral across the board. Despite growth being potentially weaker and lingering policy uncertainties, companies continue to report strong earnings. Investors' positioning remains favorable for US large caps. There's a lot of still optimism around the structural growth themes like AI that should support profits and valuations in the near term. Globally, we acknowledge, as Jay mentioned, that we've had this big outperformance within international stocks, and we would just caution a more patient approach when adding to the asset class, just given how oversold the dollar is. And one common theme across all segments of the equity market is we do continue to preach quality companies with strong balance sheets, earnings resilience, and positive cash flow generation. Lastly, just turning on to alternatives in public real assets. As I mentioned, this is an area within portfolios where we do have a ton of conviction in right now. It really can be expressed in different ways across portfolios, depending on the risk or liquidity tolerance for different clients. But broadly speaking, across private markets, we're very optimistic that these new vintages are going to be able to capitalize on any opportunities from an economic reset. Areas of opportunities really lie within venture, private lending, infrastructure, uncorrelated private strategies. These are strategies we can think of where their return stream isn't going to necessarily rely on the path of the Fed or equity markets to do well. Volatility strategies is another area that we really like. These things like structured products, where investors can capitalize on volatility and consistently achieve equity like returns with 30 to 35% downside protection. And then lastly is we do keep our underweight to public real assets. We believe there are better ways to hedge against currency depreciation and higher inflation than holding REITs, commodities, publicly listed infrastructure that tend to behave a lot like equities, which is why we would lean more towards private, less liquid infrastructure within our tactical views. So, with that, I will wrap it up and pass it on to our alts team, starting off with Michelangelo to expand more on these opportunities and what makes them so attractive.
Hi, good afternoon, everyone. So we can go to the first slide here. I think what we want to do is shed some light. Anna did a great recap of where our asset class views are. And one of those is really focused on the summary of number 3 here, which is finding uncorrelated return streams interesting with this backdrop. But I think when we came into this year, we saw both point 1 and 2, right? The chance for more volatility in markets based on a lot of uncertainty that was here. And we have most definitely seen that in the first 6 months of this year. And we saw risk assets trading potentially in a wide, choppy range, which ultimately means volatility, but it also means uncertainty for investors. If you are an equity investor, having that uncertainty can be a detriment. So having strategies that allow you to smooth out returns, that allow you to rely less on certain equity asset classes, can be a big benefit to portfolios. So hopefully what we can do here is shed some light on how things like structured products can be utilized to maximize on volatility, but also to stabilize returns. This environment specifically, we had written a white paper that came out in April of this year because this environment was so unique with its potential for heightened vol and the fact that many of these yield-oriented structured notes are almost the prime candidate for being able to maximize returns or create consistent returns in a market where there's not them. So we can take a step from here. Now, structured notes are not completely uncorrelated. And this is an important point, is that structured products and structured notes often have several risk factors that are associated with them. They are ultimately linked to financial issuers, so there is some degree of credit risk. They can have things like equity indices that they're linked to, so you can have equity risk in there. However, even with some of these major risk factors, many of them can be diversified or mitigated through things like downside protection, right? Diversification of issuers. And what we want to tend to focus on here is utilizing notes for what they can do best. And we think being able to lock in yields that play off of volatility and heightened periods of volatility, right? Those allow you to use structured notes in a way that can be more defensive in portfolios and create consistency and stability where it does not exist with traditional asset classes. It almost sits somewhere in the middle between traditional fixed income and equities. So what this chart is showing us is that we want to overlay the VIX index, which is a it's tracking equity market volatility. So when we see spikes in the VIX index, that means volatility is up. Typically, we're seeing some sort of equity sell-offs. The most recent and sharpest incline that we saw there was in April, right? We saw a major spike in equity market volatility, and equity levels in turn were also depressed. Now, what that resulted in are yield-based structured notes that could be locked in at averages of sometimes 13, 14, even 15%. And that means that, again, in these elevated periods of vol, locking in notes or being able to purchase notes at elevated levels can be an extremely attractive opportunity and a way to create that stability. Now, even in today's environment where we've seen volatility come back down, we're still elevated relative to what we saw throughout most of 2024, and interest rates remain somewhat high, but we've seen those spreads above treasuries come back in quite a bit to where new notes, yield-oriented notes, are typically in the range of about 9 to 11% yields right now. Still extraordinarily attractive if you can compare them to traditional equity ownership or fixed income, right? So again, achieving consistency of return while mitigating equity risk and sitting somewhere in the middle of traditional fixed income and equities is where these structured notes, in our opinion, can be applied best in environments like this one that are very muddy. One more slide ahead here. And to kind of prove this is showing us what realized outcomes in structured notes can result in. When we buy structured notes that focus on consistency of positive returns and utilizing downside protection, what we would hope for is several outcomes that are going to be in a tight range of returns. Unlike traditional equities, which we can see a variety of outcomes over any given 12-month or 36-month period, right? Or fixed income, where we have an extraordinarily tight band. If we buy a bond at a 5% yield, we would hope to achieve roughly a 5% yield. Now, structured notes, what we can do is ultimately create those returns in a specific band, but what we're hoping for are returns that are going to be enhanced from traditional fixed income, but give us enough upside, right? While it may not be the unlimited or theoretical unlimited upside of equities, it's going to give us enough upside that we're able to achieve kind of an 8 to 10% target return. And again, this is where we think structured notes can really be applied in a positive way. It's achieving that consistency. So structured notes and structured products are but one in many different uncorrelated return streams and alternative investments. So hopefully Maxwell can shed some light on some other options and things that are out there that look attractive today.
One thing you'll see here is that there definitely are some common themes as we think about kind of what's been developing in alternatives broadly across this year. One of the things I'd really focus on is how we've seen some of our key theses really develop. I'll talk a little bit about some of those, specifically where we see the most opportunity in a moment. I just wanted to reiterate some of the big things that we're seeing here. We continue to be cautiously optimistic across the alternative investment spectrum, really focusing on that idea of manager selection and its importance as a driver of returns. We continue to believe that there's an opportunity to invest in uncorrelated assets, really thinking about how you're diversifying the risk-adjusted return and what kind of risks you're taking across your portfolio. The higher for longer rate environment has definitely continued to be a meaningful player as we think about having significant effects and rippling effects across various parts of alternatives in different ways. As has the disruption in fundraising, where many funds are continuing to have trouble getting new capital in as they've been unable to return capital due to the slow velocity of capital and a tough exit environment. Therefore, nimbleness continues to be rewarded, and we continue to see things like AI and technology create opportunities and pitfalls across sectors of alternatives. A couple of the things that we'll be focusing on today: venture, we'll call private credit 2.0, that I'll get into a little bit further, the opportunity set that we're seeing in uncorrelated assets broadly, and the opportunities that we're seeing in infrastructure continue to be key drivers of where we see opportunities within the alternatives landscape developing over the course of the rest of this year as well as into next. I'm going to start with venture. One of the things that I really wanted to highlight was a sea change, if you will, that we've really seen across the venture capital ecosystem. Really, as more and more founders have been able to use tools like AI, but not only AI, in order to build businesses faster, to get to revenue faster, to get to profitability faster, the way that they've thought about building their businesses has changed in a really meaningful manner. We like to say that this has led to what we're calling the great bifurcation. We believe there will be two kinds of archetypical founders and funds that support them that will be successful in this new paradigm. On the one hand, we'll have founders building capital efficient businesses become infinitely more capital efficient, utilizing tools that allow them to do more with less and to stretch their resources as they build operating leverage across their businesses. These companies will need, and founders will need, a fund that is tailored to helping them grow profitably, to think about where it's worth spending the money, and to think about how to build operating leverage across their businesses. The second kind of founder that we think is going to be successful are those tackling the next set of technological and scientific challenges of our time. These are the founders going after areas like quantum computing, advanced applications of blockchain, and advanced applications of cybersecurity that become more and more important as we continue to see a greater amount of capital, but also a greater amount of need for some of these solutions. These founders who are working to change the paradigms of the systems that they work in will need a fund that has done so before, and a GP who is able to coach them through this process, not just in building out that new technology, but also in pushing adoption and helping change the paradigm that really drives the use case for these tools overall. In private credit, one of the things we've really highlighted is this idea of a golden age for some, and we continue to believe that underwriting is the key to a strong private credit approach, really focusing on that idea of having, a track record of building in downside protection, of stress testing your portfolio regularly. One of the things that we've seen emerge increasingly as we've seen an enormous amount of money flow into direct lending has been opportunities in what we'll call private credit 2.0, or areas that are outside of traditional direct lending, spaces like asset-backed finance, asset-based finance, various forms of kind of specialty lending, if you will, where we are seeing incredible interest, but also fantastic tailwinds. That's especially driven by a certain amount of asset scarcity, especially around hard asset lending, alongside the higher rate environment, which is not just driving better quality returns, but is also driving better risk profiles across that ecosystem. We continue to believe that these new spaces, in addition to direct lending, will create a more complementary feel within portfolios as you think about expanding where you're getting yield from on the private side of your portfolio. Across some of these areas, worth noting that we've continued to see secondaries pick up in a meaningful way. Some new reports saying that we're going to see all-time highs in terms of secondary volume. Still some really great opportunities to put money to work there. In growth equity, we've really started to see the kind of broadening out of opportunities set, especially with some of the new IPOs that we've seen come to market, some of which have been received very well and some of which have been received not as well. One of the things I'd highlight there is that's really important to look at even after that IPO pop, which previous private rounds may have actually, where they are marked and who actually was able to make money on these. One of the things we've been tracking and thinking a lot about is this idea that some of the later rounds are underwater despite the significant IPO pops, really leading to a thought about how things are being priced in this market. In real estate, we like to say that that is very much the kind of shakeup that never happened and the market meltdown that never happened. Starting to see some interesting things come across office, a reacceleration of rents in multifamily, continuing to be focused on some areas where we think there's a unique or idiosyncratic approach to creating return, really focused on filling some of those capital stack gaps that have emerged, really due to the change in rates from a velocity perspective as well as a side perspective. Finally, I'd be remiss if I didn't talk about the new focus on infrastructure. The thesis that we've had here has really been a three-pronged thesis The first part focusing on transportation X trucking, really recognizing that there's incredible asset scarcity there, that it's been really hard to produce assets in this environment. And therefore, the pricing and the leasing rates that you're getting on those assets has gone up meaningfully, really backed by that asset scarcity. I will note that we say X trucking because there was a really significant amount of investment done in trucking and last mile delivery during the pandemic, which we think pulled forward some of the returns there. So we're really focused more around aircraft and aircraft leasing, as well as in some things around maritime. Second piece of our thesis really focuses around what I'd like to call grid reassurance, which is really this idea that, it's not just about creating and generating more power. It's also about solving for things like intermittency and green energy, as well as grid connection and load balancing, or really the ability to get power to where it needs to be. This is a space that we've been increasingly interested in and seen an incredible amount of investment in, really on the back of the third piece of our thesis, which is digital infrastructure. I think it's really worth noting that as we look at the power landscape right now, last year we saw what was markedly one of the largest increases year on year in power demand. From 2013 to 2023, the average power demand had been about 1.3%. Last year, it was 2.2% year over year growth, really showing the need for greater power generation in the country, as well as the need more specifically for being able to transport that power and to use it more efficiently. The final piece of our thesis really relies on digital infrastructure and data centers. This is a space that everyone has been talking about, but we've been really focused on this idea of what does it mean to do this well? What does it look like as you think about the need for data centers growing so rapidly, but also needing such constant iteration as we start to see the cycles for some of these new technologies pick up and move faster and faster. Finally, moving to opportunistic and uncorrelated strategies, as we continue to see markets increase in volatility and create more uncertainty, one of the things we've really focused on is this idea of, well, how can you generate returns without getting more equity beta in your portfolio? And one of the things we've really focused on is areas like water rights, areas like tax credits that we think will be able to weather a storm, whether equities go up or down, but will also provide that ballast in portfolios as you think about generating return where the risk is relatively uncorrelated to broader markets. Overall, across the alternative landscape, we continue to be broadly very optimistic about some of the things that we brought onto the platform, as well as some of the opportunities we're creating.
We did get one question that came through to the chat. So what is the risk to the economy and markets when President Trump potentially nominates somebody to the Fed that could be more loyal to him? This is one of the concepts that Brian spoke about with the risk to the long end of the curve. We've been flagging that when you have seen headlines potentially about new Fed nominations, you've actually seen the 10-year Treasury yield go higher. So the idea being that there could be too much easing at the front end of the curve, which could result in potentially stickier inflation, maybe not as much offsets to higher deficit spending, and result being that the long end of the curve has the risk of drifting higher. That would be the biggest risk for us. Of course, that would translate to higher mortgage rates, which would weigh on housing activity, which is already quite abysmal. And that would be a key watch item. But we will see as we progress through, as we're kind of starting to see some signs of maybe those that are in the running, such as current Fed Governor Waller. Brian, do you want to add anything to that as our resident Fed whisperer?
I could whisper it. I'm not sure they're listening. But the way you need to think about this risk is the risk of having a Fed chair who is seen as compliant to the political arena for any president, for any administration, for any country is severe. But you have to think about what's the likelihood that that would actually happen, right? The Fed chair has to get through Senate confirmation, even if he nominates somebody who's already on the board. And I don't think there's anybody on the board who's particularly pliant. They may have, looser principles and when it comes to monetary policy, but there's nobody who's going to do the bidding of the president, no matter who he or she is. That person would have a very hard time of getting through confirmation. I think the list is pretty short right now. And I think at least one of the most prominent people on the list, maybe the favorite right now, as Cameron mentioned, is Governor Waller, who President Trump nominated during his first term, who's been, frankly, has been a very keen observer and commenter and policymaker when it comes to figuring out what's happening with the economy and where rhetorically and then eventually through interest rate policy the Fed should be going next. So don't see that as a severe risk right now, but certainly is one the markets are attuned to because of how much we hear from the president about the Fed chair and how unusual that is.
Well, as always, we are always here, ready, willing, and able to answer any of your questions. We covered a lot of information today. So if you have any questions whatsoever, reach out to us, reach out to your advisor. We are so grateful to have you as clients and really look forward to the second half of 2025 of working together. Have a great day, everybody. Thank you again for joining.